My name is Jasmine. Today is the next part of my personal finance starter pack, loans. So on the other side of deposit and savings accounts, you have a loan. Except for a loan, their equivalent of an APY is an APR, or annual percentage rate. And it's basically how much you pay for getting this loan. We'll go through what a loan is, what terminology is involved with a loan, types of loan, good versus bad debt, and next steps. So what is a loan? It's basically a credit vehicle where a sum of money is lent to another party in exchange for future repayment of that sum of money, typically with interest or other financial benefits. So imagine you let someone else borrow $100 of yours. If you're not super close with them, or you're not willing to just give that money to them for free, what ends up happening is that $100 is worth more now than it is worth in the future. So you want to charge them interest. It's not good enough to just get that $100 back in whatever time period you guys agree to. With a loan payment, generally, you'll calculate the principal and also the interest at the end of the term period, and then each loan amount takes in consideration the time period, like the number of months you have, and the initial amount, and also the interest rate. So what terms are used when talking about loans? The first one is the expected loan amount. This is basically how much you think you'll be borrowing. APR, which you've heard me mention before, it's a little bit more complicated than an APY, but the gist of it is that it's approximately how much you'll be paying in interest over a course of a year. Payment period, this indicates how often you have to pay the loan, so monthly or annually. Generally, loans are paid monthly. Loan term is basically the amount of time it's expected for you to pay that loan off. So how long you're going to borrow the money, or where you haven't paid off all of your loan. Payment amount is affected by the interest rate, how long your loan term is, and the loan amount. When you read your statement from any loan, you'll see outstanding principal amount. Principal is how much you originally borrowed. Every time you pay your loan, you're basically paying off a portion of your principal and also interest. I'll put a chart here on what your principal versus interest will look like after you're paying it off as you go. Another term you might hear a lot is either a secured or unsecured loan. A secured loan basically means that you have to put some collateral on it, any financial asset that you own that can be used as payment to the lender if you default on your loan. It basically means you can't pay it anymore. A very popular secured loan is actually a mortgage. When you're looking at loan terms, it's also very important to read the fine print. Are there penalties or fees related to late payments? Are there any other charges? Those sort of things. And this one is also very important. Is there a penalty for prepayment? That means if you pay off your loan early, is there a penalty for it? Yes, some places do charge fees for paying off your loan early. Isn't that funny? And lastly is your credit score. This really determines how good of an interest rate you can get from the bank. The higher your credit score, or the better it is, the better your interest rate will be. So it'll be as low as you can get it if your credit score is excellent. The basics of this is that the higher your credit score is, the better the borrower or you look for a potential lender. Because the lenders want their borrowers to pay their balance on time and to not miss any payments, and a credit score can really help give guidance to lenders on what type of borrower you are. Now, what types of loans there are? One talked about very often is a student loan. There is a lot of student loan debt in America, around $1.71 trillion in student loans, and 44.7 million Americans who hold some form of student loan debt. Among other things are car loans, mortgages, I probably won't talk at all about business loans, but another one I will talk about is a personal loan. So some of these can include debt consolidation loans, a cosigner loan, where you need a cosigner to qualify for this loan, and fixed and variable loans. So how do you know if you have good debt versus bad debt? A simple rule about debt is that if it increases your net worth in the future, then it's considered good debt. So this is stuff like a mortgage or a student loan because you are getting potential net worth from it in the future. If it doesn't increase your net worth and you don't have the cash to pay for it, it's bad debt. But just because I say student loans are a good type of debt doesn't mean that you should just pick the most expensive school on your list. Always be fiscally responsible about choosing a school. Don't choose something that's going to really be detrimental for your financial health. Some bad debts here include a car loan and some forms of personal loans. And I say some forms of personal loans because obviously everyone's situation varies, and you could be using a personal loan for a very positive reason like debt repayment, and so that's why I say personal loans. Like if you wanted to get a personal loan just to shop, obviously that is not a good debt because you are shopping with it. So that's kind of the basics on what a loan is. And now on to next steps of what you can do with this information. This includes how to get out of debt, how to figure out how much of a loan you can get, etc. How do you get out of debt? Number 1, stop taking on more debt. There are actually good reasons to take on more debt, like opening a new balance transfer where you can take advantage of the 0% APY for the first year, or consolidating all of your debt into a personal loan, which might have a lower interest rate than a lot of other credit card debt. But in general, when you are in debt and you want to get out of it, you want to stop taking on new debt. So don't open up new credit cards or apply for new loans unless there's specific and strategic reasons for doing so. And put a freeze on any unnecessary spending. Next, determine how much you owe exactly. Then create a budget, and you can refer to my budgeting video that I've linked up here. Next is choose a way to pay off your debt. So I'll speak a little bit more about this in a later section of this video. And from there, find more ways to earn extra money. This is the absolute worst case, but if the first few steps still do not get you out of debt, the last step is to look for debt relief options. This isn't super suggested, but debt relief programs or debt forgiveness programs will try to negotiate with your creditors on your behalf to try to reduce the amount of debt you owe. Before doing so, they often urge you to stop making payments as a form of leverage to the creditors. While sometimes this strategy works, but it will definitely negatively affect your credit score, because if you miss a payment, that affects your credit score. Here we move on to choosing a way to pay off your debt. There are 3 main ways you can pay off your debt. One is the debt avalanche method, the other is the debt snowball method, and the last is debt consolidation. Debt snowball starts with listing out all of your debts, not including your mortgage. From here, you organize them from the smallest debt you have to the largest debt that you have. What this looks like is every single debt you have, you make minimum payments on. And whatever left over that you allocated for paying off your debt, you throw at the smallest debt amount first. This strategy may be very appealing for those who need an extra motivation, or you need a small win in tackling your debt to keep you moving forward. Paying off your smallest debt first can give you a sense of satisfaction. Next is debt avalanche. This one is a little bit different from debt snowball. Instead of listing how much you owe in each debt, you list the interest rate from highest to lowest. And here you also make the minimum monthly payments, and whatever extra that you allocated for debt payoff goes towards the debt with the highest interest rate. This one makes a lot of sense because if you're paying off your highest interest rate first, that means the amount of interest you pay doesn't keep on increasing at a higher rate than, other options. If you keep your highest interest rate not paid off for the longest amount of time, you would end up paying more on your interest because the interest rate is so high. The last one I'll mention is debt consolidation. This way, you're attempting to reduce debt by combining your multiple credit card balances into a single balance with a lower overall interest rate or better repayment term. There are several options for debt consolidation without a debt management company. One is through a personal loan, two is through a credit card balance transfer. A credit card balance transfer sounds like scary because it's still a credit card, but a lot of credit cards offer a 0% introductory APR. So in the first year, you pay 0% interest, even if you carry on revolving like statement balance. So this is why a credit card balance transfer is included in a debt consolidation as an option. So there is a difference between the types of loans you can get and how much you can get. Obviously, this amount will differ for different types of loans. So like a mortgage or a student loan or a personal loan or a car loan, right? Usually banks or Nerdwallet will include a calculator for you to use to see how much of a loan you can get. But you can easily find one for personal loans, etc. So just because Nerdwallet says you can take on a $800,000 loan from the bank doesn't mean you actually want to do that, right? You want to make sure that you can pay the amount every single month or the monthly payment. This goes back to budgeting and seeing how it fits into your budget every month. Don't get the biggest loan possible just because you can. Always try to live within your means. So personal loans are typically not secured. This means that you don't need collateral like a house or a car to secure the loan. So the questions they'll ask for a personal loan are a little bit different because they want to gauge your financial history. This will include things like your credit score, your income, and any other lender requirements you must meet. So you might be wondering, how can I get a loan? Before I go into the steps, there are some prerequisites that you might need to know. Having a higher credit score opens up a few more options for you in terms of lower interest rates. And for mortgages specifically, some lenders actually decrease the amount of down payment you need to have if you have a high credit score. Now, on the flip side, having loans also affects your credit score. I'll put up a list of things that affect your credit score. But basically, when you add a loan to your credit history, can improve your credit mix, which can improve your score. But a loan can hurt your credit score if you cannot afford to make on-time payments. Late and missed payments show up as negative marks on your credit score. So do not take on new debt unless you absolutely need to. How do you get a loan? First, you need to know what your credit score is. With your credit score, make sure you don't do a hard inquiry on finding out what the actual value is. If you have a credit card, most likely you'll be given a FICO score every month after your statement ends or whatever. So I would say take that credit score and use that to go fill out pre-qualification forms. Some other information you might want to have includes your annual income, your age, maybe how much rent or mortgage you're paying right now. Shop around for the best rate possible, but make sure to stay safe with your sensitive information. When shopping around, one thing I've noticed is that if you search something in Google, they will start targeting ads for you, and sometimes those ads that they target you with actually have better terms and better details. Like when I was trying to get a specific credit card, I searched up the specific credit card a few months in advance, and when the time comes, they'll target you with their specific ads, and then you can get better terms. Like I got higher membership rewards points when you found a term that you're very happy with and it's a reputable lender. You can submit a formal application. But if you're in a hurry, just make sure that the lender you are choosing is reputable and the terms are within your means. So you might be wondering what your options are if you have bad credit, and There are a few good lenders who are willing to help you out, and I will link them down below, but please do not get a payday loan. They are literally the worst, and same with like other things like loan sharks. Like, do not touch those things. I know it can be very enticing just to have money 2 days early, but no, just don't do that. So another question that gets asked very often about loans is, should I pay it off early? And I think the answer here is that it depends. So with good credit, mortgage, and student loans, if your interest rate is low, like 3%, it might actually make sense for you to pay off the monthly payments instead of paying it off in full. The reason why a lot of people say that is because if you put the rest of your money into something like the S&P, which returned 16 to 17% last year, your money is likely to grow, and so you could get a higher return on the S&P at 16% than if you were to pay off your loans at 3%. Does that make sense? Let me put it a different way. So imagine you have $1,100 that you want to allocate towards paying off your debt. Your monthly payment is $100, but you could pay off your loan much more quickly if you put all of that $1,100 into paying off your loans, right? But if you think about it this way, you put the other $1,000 into something like the S&P, and then at the end of the year, you have $1,160 from your investments, while your interest rate was only 3%, so it would have been $30. So you would have net $130. I would say anything below 4% for interest rate, it might make more sense to actually only make the monthly payment, while if anything over 4%, it's very scary if the money that you originally put in the stock market doesn't increase by 4%. And I think another thing that you might need to factor in is what motivates you more. If you're able to take that $1,100 and put it all into the stock market and monthly payments, then yeah, I would think that that works for you very well. But if you're the type that if you have $1,100 and you're not forced to pay it into your loans, and you would rather like end up spending it somewhere else, because I'm not going to have put the rest of the money into. And so I think it's important to find out what works for you. Yeah, I think only if you're not tempted to spend that money. That's it for today. Comment if there's anything I missed or any tips that you all have. But thank you. Bye-bye.